Today, folks, I want to share with you the philosophy of my ignorance that led to outperforming the market and basically every finance clown that exists on this social media platform. And it really came down to this redundancy of my stupidity in my 20s, basically saying, hey, I use Xbox, I should own Microsoft stock. I like Apple. Hey, I'm going to buy Apple stock. Heck, I know they're going to legalize this MJ stuff here in Canada in 2018. My 2014-year-old mindset was like, let's just buy the largest MJ company. And boy, howdy, did I ever print them dollars. Just call me Jerome Powell, the Federal Damn Reserve, but really it had nothing to do with fundamental investing. And the more I've aged and the more I've come to understand the market, I realize I never knew what I was doing. Fundamentals don't really matter that much because we don't know what's going to happen tomorrow. And that's why most people should be putting their money into index funds. And that's why I largely today invest my money in index funds and just kind of play around with a handful of stocks. But I want to break down a ton of companies today and share with you how ignorant you probably are on things that I'm still learning, whether it comes to Palantir and Shopify and tech companies. We'll talk about TELUS. We're going to talk about price to earnings multiples, balance sheet stuff, sales and marketing, and things that I just don't think anyone considers when they're listening to these YouTubers pump stocks. Now, if that is a conversation you'd appreciate, as always, hit that like button because I want to start with two videos that iconically have been resonating with me more and more as anxiety builds into the reality of my investing portfolio. But John Bogle, the creator of the Vanguard S&P 500 ETF that we all know and love, whether it's VOO, VFE, whatever, take a listen.
I came into this business when I was at Princeton, and I worked for a brokerage firm in the summer. And one of the old runners said, Bogle, I'm going to tell you everything you need to know if you're going into the investment business. And I said, what's that, Raymond? And he said, nobody knows nothing.
It's crazy how true that is because even the likes of Warren Buffett said, when he passes away and he leaves his wife wealth or whatever, it's all going in the S&P 500 ETF. He doesn't even mention buying Berkshire. In fact, I remember on a call, Charlie Munger, rest in peace your soul, was saying, hey, I still think Berkshire is going to outperform the S&P, but Charlie Munger had to sell Berkshire because Warren's like, I would just buy an S&P 500 ETF, which basically came from the invention of John Bogle. But Warren Buffett also had a really incredible quote here that I think has largely become disconnected from people's reality of investing today.
I started out without knowing anything about valuing companies. And then Graham taught me a way to value a certain type of company that would prove successful, except the universe of those companies dried up. But nevertheless, it was almost a guarantee against failure. But it was not a guarantee that these things would continue to be available. Charlie taught me a lot about the value of a durable competitive advantage and a really first-class business. But
now I want to point out two quick things here. Firstly, the book with Ben Graham, most of that is irrelevant in today's investing environment because the market has evolved so dramatically from Warren Buffett's initial investing strategies. And he states it in this conference from God knows 10 years ago, and also quoted Charlie Munger taught him a lot about businesses having moats, basically, and talking about businesses that are undisruptible and how much that gives them an advantage into the future, especially within this ever-evolving, very disruptible technology environment, right? But take a listen to just a couple more quotes.
over time, I've learned more about various types of businesses, but you'd be amazed how many businesses I don't feel that I understand well. The biggest thing is not how big your circle of competence is, but knowing where the perimeter is. If you don't have to be an expert on 90% of the businesses or 80% or 70 or 50, but you do have to know something about the ones that you actually put your money into. And if that's a very small part of the universe, that still is not a killer.
Yeah, so I always find it interesting when I look back on my 20-year-old self because I realize that sometimes fundamentally the simplest conclusions will lead to the biggest returns regardless of valuation. You can use Tesla as a prime example of that, another stock that I made a lot of money on. When people were calling it insanely overvalued, they're still calling it insanely overvalued today, and nobody really knows the understanding of that. And we'll discuss that as we kind of move forward here. But when you look at Berkshire's portfolio, when they're sticking within that circle of competence, when I look at people's portfolios today, they are so broadly spread out between so many stocks, and sometimes just holding 2 or 3 companies will lead you to that promised land that you're not going to get from like overly diversifying. And you see it in Berkshire's portfolio. They own very simple companies like Apple and American Express. You know how undisruptible American Express is? You remember when they thought crypto was going to take over the entire payment gateway, and now nobody even talks about it, right? I mean, Apple, iPhones are basically undisruptible products, right? And these moats have led to these incredible outsized returns. Like they're even buying oil companies because it's so redundantly easy to understand in this very complicated world that we live in. They even own, I think they sold out of HPQ, but they owned a printer company, for crying out loud. Now let's talk about some of the hype stocks. A lot of people have talked about through 2023, and Palantir was probably one of the top of those lists. And this is a company I've never understood. I don't understand software well at all. I don't understand their moat. Can somebody else come in and replicate a lot of the software they're making? They're selling to companies and governments. I don't know. So I'm not going to buy it. But what I do like to look at is how the company's making money, because at the end of the day, whatever hits the bottom line is the rate of return to shareholders, and what they're able to do with that money reinvested, leads to the gains that we'll hopefully see in the future, because this company isn't really making any money outside of interest income. They're basically taking the money they've made coming public from via SPAC, I believe, and putting it all into the bank and collecting high interest. Meanwhile, they reinvest all their money like Amazon into their business. But the problem is I can't tell if it's really paying off, because we're talking about a business here that isn't as marketable to a broader audience as some other software companies like Shopify will take a look at. But you can see that their sales and marketing went from $512 million to $547 million this year. That is a huge amount of their gross profit. I mean, it's a huge percentage, right? And you think this is good. We need to get more clients. We need to grow, especially if we believe in our product and the sustainability of it in the future, and that it has a moat. So let's say we're reinvesting a lot more into marketing. Is that leading to growth this year over last year? No, it's actually making less growth year over year. So they're investing more into marketing and seeing less of a return on it, which should always be a concern, because it really shows you the diligence of the company's marketing capabilities, especially in this backdrop of a recessionary environment. You look at a company like Shopify, for example. Shopify, this is a much more marketable company. We've seen Mr. Beast even market Shopify, and we've seen the growth of this company explode this year. They've actually returned insanely well from the slowdown of 2022. They're growing the revenues by 20 to 30%, and we can see they've actually decreased their sales and marketing costs. Their marketing went from $932 million to $903 million. So we're seeing a higher conversion, but again, this is in e-commerce. We know e-commerce continues to grow. We know people are selling things online, but these are two completely different software businesses. And how disruptible are each of these? What do I know about the landscape of all this? I don't. So I don't particularly buy or trade these companies, because I can't wrap my head around values. And speaking of values and balance sheets, let's talk about a lot of things people don't understand when it comes to price to earnings multiples. I truly believe most of this is fugazi, because somebody will look at a price to earnings on a company like Starbucks, a company like McDonald's, for example, and they'll say these are very expensive companies. But the question is, are they? Because you're only comparing their price to earnings multiple based off the earnings per share, and earnings per share are highly manipulated. It's not a true, defining value to a company. It's damn near impossible to understand, right? That's why most people run multiples on sales to growth and all these things, and it's all basically fugazi. Because if we look at Starbucks, their basic earnings here, right? If we just kind of take a quick peek here, when we look at 2023, the one thing I want you to notice is the depreciation and amortization expenses. This is going to play a role in dividend payout, price to earnings multiples, because if you buy a car, and I'll break this down for newbies as simply as I can. Let's presume you buy a car so you can get to work. You're going to pay 30, 40 grand for that car. Let's say you buy it outright. Okay, that was the one-time cash expense for the year. Great. Next year, that car is going to keep making you the same revenue going to the same job. It's going to do that for the next 5 years. But over time, that car is going to lose its value. And you can take the value loss. So let's say the first year goes from 30,000 in value to 25. Well, you can write 5,000 of that lost value against your income. And that won't show up on your net earnings, even though you made the same revenue and you keep making the same revenue every year. I hope that made sense, because basically Starbucks depreciated $351 million. That did not show up on this net earnings. So let's do a little bit of math. Let's say, they actually made that money. They paid tax on that money, and let's just say their corporate tax rate's around 20%. That means they probably netted about $280 million, give or take, right? If we add that to the $1.2 billion that they earned, that would increase it to over, 14, almost $1.5 billion. So that's an increase, again, of probably just around 20%. That brings their earnings up and would lower the price to earnings multiple probably by about another 20%. So that would put their price to earnings, I think, somewhere probably closer to 20 PE, just from a depreciation cost, right? Which also makes it unreliable to understand their cash dividend. And, we can do that with companies like TELUS, right? TELUS right now trades at a high multiple, great dividend yield, but anybody that goes on Yahoo Finance, a Yahoo idiot, as I like to call them, will go on here and they'll be like, oh, the payout ratio, guys, payout ratio is 264%. Oh my God, they can't afford the dividend, derp. And I hear that all the time. I'm not trying to be offenseful, but I'm just really trying to point out your ignorance toward understanding actual balance sheets and how technical and complicated these things truly are to understand. Because it's not just understanding a balance sheet, it's understanding the damn business. Some CEOs don't understand balance sheets. They just understand the business they operate in. It's a very confusing thing to wrap your head around. So if we take a look, they're bringing about 9 cents of diluted EPS against 36 cents of basically their dividend being declared. That's where you get this crazy value of over 200% payout ratio. And people are like, oh, they're using debt. But when you take a look at the depreciation and the amortization cost of $1.5 billion, and their dividend is like literally nothing in comparison to that. I think their dividend payout, if you times out the amount of dividend times their shares outstanding, is like somewhere in the 500 million range. I mean, they're writing off like 3 times the value of their dividend that should be hitting the bottom line, that should be affecting this price to earnings multiple here, because there's no way the price to earnings is 42. And there's just so much convolutedness behind this that it makes it really insane to try and think you can understand half of this. I mean, it's just truly insane, right? Look at a company like Tesla, and I've stated this over and over again. How can Tesla, a company that is no longer growing, I mean, its growth rate is in like the single digits still for most of the year, against a company like Berkshire Hathaway that makes 3 times the revenue and is growing at a 20% clip this year. Yet, Berkshire trades at a total price to earnings multiple of like 10, and Tesla trades in the freaking stratosphere of somewhere around 80. I mean, it really kind of makes you understand, like, what is the branding power, and is it truly going to be sustainable into the long term with a company like Tesla? It could be. They could make these robotics, and in the next 10 years, the company could 3, 5, 10x their entire revenues. It's a real possibility, but it's a huge gamble and a huge thing to understand that most people just never will. That's why it's intriguing. Tesla and Berkshire trade for almost the exact same market cap, and don't even get me started on like diluted EPS, something that most people haven't even begun to understand. Like companies like TELUS are diluting us as shareholders. This is not a good thing. This is the thing you have to take into consideration when you're buying stocks, because even Palantir is diluting shareholders, right? Probably through work-based compensation or God knows what, but that takes away your piece of the pie. And most people don't understand the relevancy or the importance of that. But if a company like Apple is seeing declining revenues, yet their earnings per share is growing, how is that possible? Because they buy shares off the public market, making your piece bigger, which means the earnings that come into the company are bigger on your piece of the pie. I mean, there's so many fundamental realities that come into play. And this is why I don't really show a lot of my individual investments in things like crypto or gold and silver or small caps. Even though I've seen great returns on a lot of my small cap investments, I try not to show you that as often here, because I understand that's not really helping you as a long-term investor. Like, I'm going to be buying individual stocks still. Like, I love Google. I'm going to be buying Google, and I'm going to do a video on it and tell you all the things I hate about Google, because I'd rather look at the things I don't like to get a better understanding of the business. Because somebody that's run a business, who has been self-employed for so long and has been learning, I don't really know anything, and most of this is pure fugazi, you're much better off cost averaging into broad-based ETFs. And that is a message that I'm hoping is resonating with my audience as I continue to share with you my financial independence, or my financial path to independence, to perhaps one day retire early. And I'm hoping you're on that same journey, and consider subscribing so we can grow on this journey together. But I'd love to know what you think in that comment section below.